Hi everyone, welcome back to BeRich. I know it's just me today, but there's a couple of interesting things I read today morning, which I had posted about on Instagram and on LinkedIn. So I thought I'd talk about that today, and I'll try and talk slower, and I will try and not keep my tone monotonous, as they said, because some of the comments coming in is that Vinod, you're a little boring, you're monotonous. So I'll try and liven it up and keep my voice modulation from going down all the way up. Anyway, jokes aside. So, what is the article I read today? It was in Financial Times about gold. And they said gold has got into a healthy correction, that it went past 4,000, 4,300. Now it's dipped and it's come down by 27% and it's cooling off. And it was all driven by speculation, and that momentum is over. And at the London Bullion Market Association, uh, the conference in Kyoto, the traders noted that the prices could fall further, possibly to 3,700 to 3,500 before finding stability again. But then, near-time caution was quoted by HSBC and Bank of America and Societe Generale, saying continuing the possibility of 5,000 by 2026. I think it's a whole lot of hogwash to me. The reason why I think it's hogwash is these same guys could not see that gold was going to go there to start with. So there's no way they can predict where gold is going to go and sit finally, because there's a lot of moving parts when it comes to this, which was what was missing in the article, which I found, you know, a little sad. Usually FT does better, because first, calling this as a surge as a speculative thing, kind of ignores the broader macroeconomic context. Gold rallying, okay, coincided with the falling real yield, persistent deficit in the US, and the currency pressures in Asia. Okay, these are not just random trading impulses, but reflections of a deeper economic issues. That's the first one. Second, the article only briefly touches central bank of buying has slowed, but didn't explore why are they slowing. Because many emerging banks, especially China, India, Turkey, have been purchasing gold as a long-term strategy to diversify away from the dollar. Even India, I think, I read an article where the RBI has bought 64 tons or something. So to reduce exposure to sanction risk. You don't want to, if you upset the master wants to punish you. You don't want to be in a position to get punished. So that's a structural shift happening, which it's not a short-term trend, which I feel the article missed. Third, they said the most commentary came from bullion traders and refiners who naturally focus on short-term movements. Missing, there are sovereign funds, there are pension managers, there are retail investors across Asia, especially in India, who treat gold very differently, and they look at it as a long-term protection rather than a speculative trade. Four, it didn't place gold, equities, and bonds, and understanding that relationship and what happens in price behavior, especially when stocks and bond yields raise together, gold often softens. So, when risk assets stumble, the role of this to store value strengthens. So, that was missed. The fifth thing which was missed in this article, which I feel, was ignoring inflation expectations, weakening of credibility of fiat currencies. Gold often reflects this. The loss of confidence in paper money is not a response in short term. It is uncertainty which people feel all over the world, and they flock to this. And I see there's a lot of that in the world right now. And this cannot just be a speculation driven thing, because exchange traded funds inflows, future positions, derivative exposures are all being claimed. But the article did not reference any of this. It just kind of like broadly spoke, hey, this is there, that is there, maybe it is this. So, this is what I felt was missing. Yes, the pullback is, healthy. There's no doubt about it. But there's more context to this, is what I'm saying, because today the Fed is expected to do something with the interest rates. And that is something you can even see in the S&P 500 chart, which I'll ask them to put up on the screen. Okay, this chart, it has two key indicators: the S&P 500 index, which is a red line. Then there's an advanced decline, which is the blue line, which is in sharp divergence, okay, between the price and the market breadth. So what is the red line? That is the S&P 500 index. For those of you who don't understand, this index has steadily been climbing session after session. Okay, today it's gone to 6,904, I think, at the highs, suggesting the prices are rising further and further. the blue line, which I said is the AD line, which is advance and decline line, measures how many stocks are advanced and versus the amount which are declining. Okay, that has sharply fallen throughout the same period. Okay, closing around 239. That's indicating far more stocks are down than they are up. So that shows more and more reliance in the S&P on a few stocks, those AI stocks, those tech stocks. Everything else is in decline. So it shows a huge divergence. And that green dotted line is showing how the index has been rising while the market breadth is being declined. So what does this mean? Why am I talking about this? Why is this important? Because it's just saying all the headlines which we're talking about, the S&P 500 is concentrated on a huge large cap stocks. And we just saw what was being done with Nokia and Nvidia. Nokia has been in the news for the simple reason Nvidia has decided to invest $1 billion. So they've been playing musical chairs. They're running out of chairs, so they're pulling one more chair in. Nokia, come, you also join, man. You also come and join the circle finance party here. We're yet to see how this whole $1 billion is happening. Is it like what's happening with AI? We have to see what concocted ideas they're going to come with, because this divergence is usually, right, precedes a short-term pullback or market exhaustion. This kind of a crest wave, about before the wave crashes. These kinds are the markers. These are the signs you see the wave is being pulling up. You see the velocity of the wave slowing down before it decides to crash. So that's what they're saying. These kind of classic late cycle signals, these are called, right? So the S&P looks strong, but beneath the surface, the participation is thinning out. Only a few giants are carrying the index higher and higher and higher, and majority of these stocks are slipping. So this is what it remains. Meanwhile, another interesting graph I'll throw up on the screen now. So this is from Bloomberg Intelligence. It shows the S&P 500 companies reporting sales and revenue. How the sales and revenue have been beating analyst expectations. So the headline number is 69%. In 2025, so far, 69% of the S&P 500 have beaten revenue and estimates. That's the highest beat ratio in 4 years. So why does this matter? Because sales beats are harder to manufacture. You can't manufacture these numbers. These are actual numbers of sales. So it reflects real demand for products and services. It's saying 69% beating means that corporate America is seeing robust demand, that the American economy is resilient, so blah, blah, blah. All this is being said. But if this is all very true, then strong sales can also keep inflation sticky, complicating the Fed decisions on cutting rate. Okay, companies' revenues keep growing, though prices are going higher, maybe doesn't mean the volumes are higher. So is there margin pressure? We don't know. So this data that corporates outperforming, 70% positively on sales, best from 2021, maybe another sign that is not resilient, but it's another late cycle economy, which is what's happening. So there's a lot of things which you should read into when you put all this together, right? And that is what I want to talk about. I want you to keep in mind that markets often look the strongest right before they turn fragile, right? The ice, the thin ice, always from a distance looks like a thick ice. When if you've ever gone skating on frozen lake, you would know this. As you are skating, the ice can thin out and you won't know that you're skating on thin ice till it's too late. You would have started on thick ice, but as you're growing, you can hear the echoing cracks across the lake bed. Those of you who have done that kind of skating, and you will know you're reaching, thin ice. So maybe it is that, maybe it's not. But I would say, the wise thing to do would be to read what's underneath these numbers and just not the headlines which are rising. Because a lot of you, what you're doing, because you don't have time, you are scrolling through different sites, Wall Street, FT, Bloomberg, CNBC, whichever your flavor. I don't know which ones you guys are reading, whatever you're reading. And you're like, maybe I should do this, maybe I should do that. But being a good value investor means you should deep dive. You should peel back the layers, get down into the weeds of it and see what is really happening and try to understand it. that would be the wise thing to do in this kind of a situation. So I wanted to share this because we are expecting Fed news tomorrow, which I will talk about. I'll probably be recording that remotely because we're traveling. We're heading out to Paris and London to meet you guys. So I'll probably get the news of the Fed later in the evening when I'm at the airport. And once I have had time to digest it, I definitely have Anand with me, and I'll turn on the phone and I'll record a quick video. And you'll get to see that tomorrow, what we think about. Hopefully I'll get some good audio there. If I don't, I'm apologizing ahead of time, and we'll try and do our best. But this is where it stands. It's an interesting time, and let's wait and watch, see what the Fed does and how that will send gold where you think gold is going to go. If the Fed cuts interest rates or doesn't cut interest rate, it's going to be curious, because either way I think there's going to be some momentum on gold. Maybe I'm wrong. Let's see. What do you think? Put it down in the comments. I would love to read it. I did enjoy reading all what you guys are doing with the biotech space yesterday. I'm in agreement with most of it. So if you are investing in biotech, do your research there too. Like I said, a lot of them are burning cash and yet to show any profitability. End of the day, you need to make money. Business is about making money. Just not about, the prospect of making money. Can't be on that frame forever. Thanks for being with me and Sadhu on BeRich today. It was wonderful having this conversation by myself. Thanks, guys, and I'll see you tomorrow. Chalo, bye.